Good afternoon, everybody. This is Eric Anderson, President of SEDCOR, and I'd like to thank you for joining us on our monthly webinar. These business forums have transitioned to an online version until we can all get together in person again, but we're hoping you find this not just informative, but a way to kind of stay engaged with SEDCOR and our partners and be able to at least feel part of a bigger world. And a lot of us have kind of changed the way we do business. Today's topic is going to be around the hot topics for Oregon business, and we're happy to have Sherman Sherman, Johnnie, and Hoyt law firm here in Salem as our sponsor for the event, and also our content providers today. Mark Hoyt is a longtime SEDCOR supporter and board member and previous chair of our organization. And I'd like to, before we get the program started, invite Mark to say a few words on behalf of Sherman Sherman, Johnnie, and Hoyt, and also thank you, Mark, for your sponsorship of today's event.
Thank you, Eric. It's good to be here. Before I say anything, I want to say thank you to the folks at SEDCOR. We all know that we're living in a different and challenging time, and the folks at SEDCOR have done an outstanding job of making sure that they remain relevant, continue to serve client needs, and continue to serve businesses in the Willamette Valley. And it's been my pleasure to watch Eric and his team respond and do what they do. So we at Sherman Sherman, Johnnie, and Hoyt are very pleased to sponsor the event. We look forward to presenting what we hope will be some relevant information. We have great confidence that businesses in Oregon will have an opportunity to trigger the $1 million cap that will result in taxes. And so I think Steve's presentation on the impact of the new tax bill will be very relevant and timely for folks as they come out of this process and start getting back to work. And similarly, when Justin has an opportunity to speak as well. And Justin's going to talk about employment issues, and very soon people will be back to work. So with that, I'd like to introduce one of two members of our team that are going to speak today. The first is going to be Steve Elzinga. He's an attorney at Sherman Sherman, Johnnie, and Hoyt, and is a fourth-generation Oregonian who assists clients in civil litigation and appeals, land use, property development, and general business matters. He enjoys identifying creative solutions for those impacted by government regulation and has a boutique election law practice. Before Steve joined Sherman Sherman, Johnnie, and Hoyt, he worked at the highest levels of Oregon government. There, he managed a state agency legal portfolio, crafted an award-winning administrative rule protecting the voting rights of over 60,000 Oregonians, and helped negotiate a multi-billion-dollar partisan grand bargain in the Oregon legislature. Steve enjoys strategy board games, hiking, and spending time with his wife, Sonia, two kids, their friends, and family. I look forward particularly to Steve's comments today and are just happy to be here, and that SEDCOR is facilitating the opportunity for us to be able to bring some information to you that we hope you find relevant. Thank you very much.
Thank you, Mark. I appreciate the introduction. My name is Steve Elzinga, and I'm here to talk to you about the new corporate activity tax, otherwise known as the CAT. It's going to be affecting a lot of businesses, whether or not you reach the threshold and are directly impacted, or whether you're indirectly impacted as a result of how it impacts other people. It's something that all businesses should be aware of. So I'll go ahead and start sharing my screen. And in 2019, the Oregon legislature created the CAT, the tax on commercial activity to fund education. It started taking effect January of this year and is estimated to have at least $1.4 billion per year in impact. And the legislature called it the corporate activity tax, but it's important to recognize that the tax actually applies to more than just corporations. It applies to LLCs, LLPs, individuals, and others. So I'll just go ahead and refer to it as the CAT for this presentation, which is a lot more fun. And here's why you should care about the CAT. The CAT is going to directly impact many businesses that are taxed. It's going to directly impact a number of owners of those businesses. It will also directly impact education funding. However, if you're a smaller business that's not directly impacted, you'll still be indirectly impacted because it's going to impact contract provisions with businesses that are impacted. It's going to impact reporting obligations for many other businesses. Generally, it will affect Oregon economic activity and the cost of most consumer goods that at some point will be taxed through the CAT. So whether you're a small business or a large business, whether you are directly impacted or it's your customers or suppliers that are impacted, everyone should pay attention to what's going on with the CAT. Now, the CAT is fairly complex, and the best way I think about it is for those businesses in Oregon who are subject to the CAT, it's like being a passenger on a plane that's being built mid-flight. It is not entirely settled. There's a lot of ambiguities on what it does and does not apply to. The Department of Revenue continues to do administrative rulemaking to try and iron out ambiguities and to clarify, add, and remove restrictions. So if you take away only one thing from today's presentation, that is nothing is stable in terms of how the CAT applies, and it's something that each business needs to be monitoring to see whether or not it currently affects you, how it affects you, how it may affect you in the future. An example of how complex it is a graph that was put together by the Tax Foundation when the bill was being drafted. This is their attempt to simplify the bill. But if you look at it, it looks fairly complex, even if it's most simple version. Now, this was just a draft of the bill. It's not the final version, but it gives you an example of how complicated it is. So when you're thinking about how the CAT may impact you or your customers or suppliers, you have to start with the tax base that is being affected. And basically, it's a gross receipts tax. It affects all commercial activity. There's a definition here on your slide. And if it has any sort of transaction or service, sale, et cetera, and there's any financial aspect to it, basically, it's going to come into the tax base initially. However, there are 47 specific exemptions in the statute, and that doesn't even cover the different standards that apply to financial institutions and insurers. An example of how complex this can be is the fact that groceries, as defined, are exempted. That means a bottle of water may be subject to the tax if it's sold at a grocery store, but it might not be if it's sold at a movie theater, because it might not fall under the definition of groceries. So again, very complex. And there are some entities that are entirely exempt, most nonprofits, hospitals, long-term care facilities, some farmer co-ops, and governments. I'm just going to briefly go through a few of the exemptions so you can get a feel of the general things that may not be covered, but again, there's a number of them, and I'm not going to cover all of them. So if there's a specific thing that you are interested in terms of your business, that's something where you'll either want to check the statute or talk to an attorney or tax accountant for advice. A number of taxes that are collected by the business are not considered commercial activity, although it is revenue coming in. And repayment of loan principal is not covered. Certain real estate commissions are not covered. Dividends received are not covered. And for a lot of business, a really important one is forgivable PPP loans. Initially, the Department of Revenue considered whether they may be taxed as part of the commercial activity tax, but ultimately decided about a month ago that those forgivable PPP loans will not be covered. So that's good news for a lot of struggling businesses. Other exemptions cover food and agriculture. One that's really important for a lot of farmers and agricultural entities in the Willamette Valley is receipts from sales to a wholesaler in this state if the seller receives certification at the time of sale from the wholesaler that the wholesaler will sell the purchased property outside of Oregon. And this is one that has been tripping up some businesses because it's important that if that exemption is going to apply, you have to receive the certification at the time of sale. You can't just have a business, for example, that does 200 different separate transactions to a business partner that frequently work together and have one certificate that covers a whole year. Every individual transaction has to have a separate certificate, and that has to be done at the time of sale. So you can't go back later and create certificates. So that's a big thing to be watching for if you're potentially covered by that exemption. And there's other exemptions for food and agriculture as well. Another important thing to think about, especially if you have customers that are outside the state or have subsidiaries or other partner entities outside the state, is the tax base. And it looks at what activity is actually sourced to the state of Oregon. So if real property is sold in the state of Oregon or rented or leased, then it applies. But if a watermelon is delivered in the state of Washington to a purchaser in the state of Washington, then it wouldn't be sourced to Oregon. It's only if something is delivered to a purchaser in Oregon or other similar things like that. There's also a concept of unitary groups that's important to be aware of. Now, this is fairly complex, but the basic idea is if you have a group of entities that all work together and effectively are functioning as a single business, they're all taxed and considered as a single business. So this is one where you want to get legal or accounting advice on whether your group of entities might be considered a unitary group. And that can have important impacts in terms of the subtractions you take, which I'll get to in a little bit. So looking at subtraction, so you take your overall tax base and basically your overall gross receipts for the year, and then you are able to subtract 35% of one of two things, either your cost inputs, which is basically your cost of goods sales. Think of, again, the water bottle. If you're taking that water bottle and it costs you X amount of money, and then you sell it for Y amount of money, you can subtract 35% of the cost of the water bottle from the calculation. The other option is to subtract labor costs. So for most service companies, our law firm, for example, will be subtracting labor costs. You can't do both. You have to pick one or the other. And that's, again, where the unitary group concept is very important to know up front, because the entire unitary group has to make a selection to either go with costs or labor. And you can't go with whatever each entity's one is most important. And one other thing to mention, I forgot to mention at the beginning, but if you have any questions as we go through, please use the Q&A function at the bottom of the screen, and we will cover those questions at the end of the presentation. There's also a special exclusion that applies for certain residential construction contractors. Again, you'd want to look and see if that specifically applies to you. So now you look at the tax rate. Every business that's subject to the tax that has over $1 million effectively in gross receipts after calculating the 35% subtraction has to pay $250 in flat tax and then 0.57% of Oregon source business receipts. A lot of businesses have asked, can you pass on the cost of the CAT to customers? The answer is yes. You are allowed to do that, similar to how a lot of businesses in sales tax states will just display on their receipt that there was a cost of, $2.25 for the sales tax. You could do that on your receipts as well if you wanted, or your invoices. However, the thing to remember is even if you pass on that cost to your customers by putting it on invoices or receipts, the amount that they pay as part of that is part of your gross receipts overall. So for example, if a business earns $10 million and tax a 0.57% fee onto all sales, this nets an additional $57,000, which also counts towards your commercial activity. Thus, you're going to have to pay a bill of $324.90 on that amount that's taxed. So they're going to hit you with the tax there as well. And this has surprised a lot of people. In fact, the goal of the bill was to fund schools, and yet schools were surprised when this actually increased the cost of their construction for new schools and repairs and upgrades, as contractors have had to pass on costs to schools. So it's not just schools, though, that will be looking at increased costs. It'll be all of us, as anyone affected by the tax has their costs going up. They'll likely pass many of those on. You're also required to use the same accounts used for federal tax purposes during the year, so you can't switch back and forth based on what affects you. Now, even if you're not sure that you're going to hit the $1 million threshold, if you are going to hit the $750,000 threshold of commercial activity, irregardless of subtractions or anything else, then you are required to register with the Department of Revenue. So if you think you might be close to that, you can wait until you get close to the $750,000 threshold, but you have 30 days from when you hit that to register with the Department of Revenue. So even if you end up paying no tax because you don't hit the $1 million threshold, you may still have to register. And that's a thing to keep in mind, because that registration threshold might happen mid-year when you're not thinking about whether or not taxes are applying. The Department of Revenue also has authority to require record keeping, and they have not detailed that in administrative rules, but they will shortly, or I expect that they will soon. And note that the law allows them to do record keeping requirements for any business, whether you're required or to pay the tax or not. So we'll see what they end up doing with that. Quarterly payments have to be made the last day of April, July, October, or January for this year. And a lot of businesses, when we were looking at the April 30th deadline, faced a big question because of how COVID-19 has impacted business. It's really hard for some businesses to estimate what their total revenues for the year are going to be, and how is that going to interplay with their cost of goods and labor costs, et cetera. And so the Department of Revenue did issue a rule that allows for good faith efforts at that payment of for the April payment, at least, based on COVID. But the July payment, October, and January will still be due. And so it's important to keep track and estimate as close as you can, because the law requires it to be within 80%. So as you think about for entities that might be your customers or suppliers, that tax payment is hitting them at multiple times during the year, so that may interact with you as well. Taxes due upon the sale of a business if a business is sold mid-year, and this is something that might catch people unaware. If you are selling your business to a new owner in July, you've accrued 6 months of tax liability at that point, and it's due within 45 days of the sale. So that's something to look out for as well. Administrative rules and future changes are continuing to develop as we speak. There are a number of permanent and temporary rules that are in place at this moment. So we don't know exactly what the final administrative burden will be. And you'll need to be tracking this if you are affected potentially by any of the rules. The next public hearing for rulemaking is June 23rd, and you can see the 4 different rules that are under consideration at that point. This is phase 2 of their rulemaking. The first phase was done about a month ago. And so this goes back to what I talked about earlier, where it's basically the state is building the plane as it's in flight. And so for a lot of businesses, you're halfway through the year and the department has not yet finalized all the requirements that you will need to follow. So it makes it really hard for this first year to know exactly how much you're supposed to be paying in your quarterly estimated payments. There may be additional legislative amendments. There have been numerous changes that have been proposed to fix quirks in the law and unanticipated results. There were a number of consensus changes that passed on a bipartisan basis in the House committee in February, but it never received a vote because the 2020 session ended up being a failed session with walkouts. And so the changes did not pass this year. On March 25th, the Joint Coronavirus Response Committee recommended passage of these changes in any special session, but no special session has been called. If there is a special session called soon or later in the year, we would anticipate that there's a good chance that these changes will be adopted. And this slide shows an overview of the types of changes that are being considered, but obviously we can't know for sure until there actually is a special session, or possibly not even until next year. So let's look at some hypotheticals of how this tax will work out on an on-the-ground basis. Let's take hypothetical 1 as an accounting firm. They have $2 million in receipts and $200,000 in non-labor costs for building, utilities, insurance, et cetera, and $1.8 million in labor costs. So when you subtract the amount of labor, though, to partners in a partnership who receive guaranteed payments or distributive income, that amount of money isn't able to be subtracted. So only $750,000 of their $1.8 million in labor costs is actually allowed to be subtracted. And when you subtract that and you have at the 35% rate, that results in $262,000 subtraction. And you hit the, you minus the $1 million threshold, you end up with a liability of $4,400 some odd dollars. So you started with $2 million in receipts, you ended up with tax of $4,000. So not a huge number, but still something to be aware of. And a lot of people might not have realized that the payments to partners in the partnership were not able to be subtracted. Let's take another hypothetical. This one's a pizza restaurant. They also have $2 million in receipts, $1 million home delivery or takeout, and $1 million on-site consumption. Due to the groceries exemption and the $1 million threshold, there's no CAT liability because the the home delivery is subject to the grocery exemption, but the on-site consumption is not. You're still, though, above $750,000 in Oregon commercial activity, so you have to register. Let's take hypothetical number 3. This is a hardware store. They have $3 million in gross receipts for the year. They actually lost money this year because they had $1.5 million in production costs, in products costs, and $1.5 million in labor costs, and $200,000 in other costs like facilities. So the thing to remember is profitability is not relevant to whether you owe a CAT payment. The $1.5 million in products or labor can be used as a 35% subtraction. So you can subtract for $525,000. You subtract out the $1 million threshold, and that gets you to a taxable amount of $1.4 million and a CAT liability of $8,657. So even though this business had a net loss for the year, they still have an $8,000 payment. So this is something else that is likely to catch a lot of people unaware, that even if you are on track to lose money, you still could end up with a CAT liability. And that's something you have to keep in mind for budgeting purposes, because that's going to mean you lose even more money. There's a number of resources that I've linked to on this presentation, which SEDCOR will be posting afterwards. The Department of Revenue has a good FAQ section and an overview of administrative rules on their website if you're curious on specifics on how it might affect you. There's background on the CAT legislation and codification with the state legislature. And of course, if you have any questions, you're welcome to reach out to our office as well. Just have to add the disclaimer that this presentation is not official tax advice, because everything depends on the specifics of your business and those 47 exemptions and how you may or may not impact with administrative rules that are still being written, et cetera. So you should definitely consult with a tax advisor about any questions if you're unsure how it may impact you. But even if you might not be subject to paying the tax, as mentioned earlier, it's important to remember that a lot of your customers and suppliers will be subject. So it's important to keep that in mind. Our next speaker is going to be my colleague, Justin Thorp. And I'm trying to exit out of my slideshow here so he can get in. Justin joined Sherman Sherman, Johnnie, and Hoyt in 2015 after practicing in Portland since 1998. His practice focuses on employment law, commercial litigation, and business support. His extensive experience litigating employment claims, real estate and construction disputes, and injury claims. So without further ado, I'll hand it over to Justin.
Thank you, Steve. So I'm going to talk about some of the recent changes in employment legislation. And since 2015, just in the last 5 years, there has been a blizzard of new employment laws. And let me see if I can get my share screen up. Steve, you might need to exit out of yours. So since 2015, there has been a blizzard of laws and some major legislation, including on minimum wage, sick pay, anti-discrimination laws, and other matters. What I'm going to focus on are the just one of those laws, which is the Pay Equity Act of 2017. It creates a significant liability trap for employers. And I think it has not gotten the attention that some of the other recent changes have. And I'm sorry, can somebody tell me that I am still live?
You're live.
Okay, thank you. So I'm not getting the share screen function here. I do have slides that we can send out at the end of the presentation. So the, oh, here we go, thank you. Okay. All right, the pay equity law is a non-discrimination law. It arises out of a series of efforts at evening pay out in the Oregon legislature, that including wage transparency, a law just last year that strictly prohibits non-disclosure agreements and severance agreements even. And there have been plenty of other laws in recent years. If time allows, I will address some of the recent legislation involving the COVID-19, which is mostly on a federal level. The Pay Equity Act, the reason that I wanted to focus on that today is because of the liability traps it really contains. Now, on its surface, the Pay Equity Act is basically a non-discrimination law. It discriminates against compensation between different employees who perform comparable work, and it prohibits the discrimination based on protected categories like sex, national origin, race, and the usual discrimination protected classes in state and federal law. On its surface, this looks like it's duplicative of other existing anti-discrimination laws. Title VII, Oregon has already had extensive anti-discrimination laws on the books. Where the Pay Equity Act really changes things, though, is that it effectively shifts the burden onto employers in what would be otherwise a normal discrimination case. If an employee can prove a pay differential and makes an argument, a colorable argument that the two jobs are comparable work, the burden is back on the employer to justify the difference in pay. And the law further limits the tools that an employer might have to make that case. The key terms in the law are that the discrimination cannot be between different jobs that are, quote, comparable. Now, it doesn't matter if the jobs are not exactly the same. They can have different job titles. The operative issue is the work comparable? And that can be a pretty fuzzy category. Somebody could describe what I do as I sit in front of a computer, I write emails, I write documents, I talk to clients and witnesses on the phone. Somebody could describe my secretary. She sits in front of a computer, she writes emails and documents, she talks to witnesses and clients on the phone. Obviously, those aren't really comparable work, but the point is describing what is comparable and not comparable to people outside of your industry can be more difficult than it sounds. The discrimination cannot be in any kind of compensation. They look at compensation holistically. It's not just wages. Comparable character does have some definition. There's a multi-factor test, but it is still a fuzzy test. And I would guess in many or most cases, it's going to be easy to get past summary judgment on whether whether two jobs are really comparable in character. Now, the law does allow employers to justify pay differentials based on a system of seniority, merit, production, other bona fide factors. The key here is it has to be a system and has to be in use at the time of the alleged violation. So it's not good enough to look backwards and say, and be able to prove in hindsight, we can show that this employee was more valuable than that employee. Rather, the employer is going to have to show that their difference in pay for comparable work, whatever that means, was based on a system that was in existence at that time. And something, it doesn't require it to be written, but obviously from an employer standpoint, if you're defending one of these claims in court, you would strongly prefer to be able to have a written document at that time that justifies the pay differential. The reason that I think this hasn't got as much attention yet is that it's still rolling out. Even though the statute was originally enacted in 2017, it's already been amended once, and currently it's only being enforced by Bour. So there's really not the incentives for lawyers to solicit clients and line up these claims. Now, once lawyers start doing that, which is probably going to start with a lot of claims in 2024, the damages can be severe. Just as in other discrimination claims, they can include back pay, non-economic damages, in other words, emotional distress, pain and suffering, punitive damages in an appropriate case. The law also tries to encourage employers to treat pay decisions more systematically because it does allow for damages to be mitigated if employers conduct an equal pay analysis, which raises the question, what is an equal pay analysis? And I don't think anyone really knows. The statute does not define it clearly. Bour's technical assistance page is basically a wall of text. I've seen different guidance online. Some people say it requires a regression analysis. My guess is that between now and 2024, when the civil lawsuit part of this kicks in, there's going to be a new cottage industry of consultants offering to do an equal pay analysis for employers. And of course, the trap here is that this just isn't the way that a lot of smaller employers work. It really views compensation decisions the way that would work with a larger organization, a large institution, a multi-state corporation, or a public employer that has tiers and some kind of objective criteria for how payment decisions are made. Smaller employers don't and often can't afford to work on that basis. Decisions typically are made on an ad hoc basis, but that is exactly the thing that the pay equity law is intended to discourage. The whole premise of the law, correctly or not, is that that kind of ad hoc decision making has driven or contributed to pay differentials between people of different protected classes. as I said, the law has already been amended, and interestingly, the amendment did two things. One is it clarified the definition of system. So they are really emphasizing that pay decisions have to be systematic. They can't be justified in hindsight. There needs to be some ability to show that the pay difference was made at that time based on an existing system. Other recent anti-discrimination laws that also affect these things, I covered the Workplace Fairness Act, which limits what you can do with a severance agreement. The other very potentially, I shouldn't say catastrophic, the other major liability concern with that is it expands the statute of limitations. It's up to 5 years now for workplace discrimination claims. And then as part of this series of equal pay legislation, Oregon also passed a wage transparency law, which is something that I think a lot of employers can easily run afoul of if they are not aware of it. In particular, it does not allow employers to inquire about the past compensation of applicants for new employment, which if you're hiring somebody, that's typically something you would want to know. How much did you make at your old job so we can figure out how much to offer you for your new job? You're not allowed to ask for that anymore. It also prohibits employers from retaliating against employees, either for sharing their information about what they are paid, or for asking about what other employees are paid. And I mean, that can put an employer in a tough position if one employee is asking another, hey, how much do they pay you? And the other employer says, hey, I don't want to talk about it. I tell the other employee to leave me alone. Employers can't really retaliate against the employee for asking. Now, they don't have to tell the employee about other people's compensation, but they are prohibited from retaliating. Now, we have just a little bit of time before we go to the question and answer session. And if you have questions about any of these, I do encourage you to ask that. Really briefly, the other major employment issue in the last 3 years, of course, has been the coronavirus. A lot of those issues have gotten pretty quickly fleshed out in a pretty short amount of time. From a legislation issue, the main new law has been the Families First Coronavirus Relief Act. That creates an entirely brand new category of employee sick leave. It is structured a lot like the Family Medical Leave Act, but it applies to everybody. So even employers who are not subject to the FMLA or the Oregon version of that are still going to be subject to the same leave requirements. And it also jumps in front of any other type of paid leave. The other big coronavirus issue that I think employers are having now is the reopening. How do we reopen in a way that is going to limit our liability if somebody gets sick? The good news there is there are a lot of resources on that. The Oregon Health Authority actually has a pretty good page on that, specifically for guidance for employers. There's more detailed guidance offered by the CDC or federal OSHA. Now, with that, I think I am going to let us go into the Q&A portion of this, and I will figure out how to get out of my shared screen.
Thanks, Justin. I'll go ahead and start reading the questions that came in earlier on my presentation and answering those. And if you have any questions for Justin, go ahead and type those in the Q&A at the bottom of your screen. So the first question was, I'm just going to read it, is a portion of the CAT collections going back to the general fund? The answer is both yes and no. So in the fiscal form that was done for the bill when it was first passed, the Legislative Fiscal Office analysis said that some of the money from the tax would go, approximately $423 million, to backfill lost general fund revenues resulting from the tax portions of the bill. Additionally, besides the backfill, overall, there's no restriction on the legislature taking money from the CAT and putting it in education and then pulling a similar amount of money from education to go somewhere else. So in the general fund budget for 2019-2021, there was approximately $8.2 billion for K-12 education, most of that in the state school fund. And if the corporate activity tax is bringing in $1 billion, $2 billion, depending on the commercial activity, that's far less than the amount that's currently in the K-12 budget. So there's nothing that prevents the legislature from taking an equivalent amount of money out of K-12 education and moving it to other portions of the budget. So although the bill itself does not allow the CAT funding directly, or most of it directly to be allocated to the general fund, the realistic practical effect is the legislature can use the money pretty much however they want, because they can just move money around between budget areas. The second question received, I will go ahead and read. So I as an Oregon commercial contractor bidding on a project in Washington State will have to pay the CAT tax, thus making my bid higher than an out of Oregon contractor. So the answer to that is probably not. If, let's see, I'm not able to share my screen, but in my presentation, I talked about sourcing of the commercial activity. And so a key part of how the tax is calculated is whether the activity is sourced to Oregon. So if the bid is for a construction project in Washington, all the services, the personnel services for constructing the project are done in Washington. All the products are delivered to a purchaser in Washington. The sheetrock, et cetera, is all delivered there. That would mean that most likely it would be considered as sourced in the state of Washington. So I don't think that that will put an Oregon contractor at a disadvantage to a Washington contractor. That issue for contractors and for agricultural producers and for many others was a big focus of the discussion that was had in the legislature on how to structure this bill. And ultimately, there were a number of exemptions put in for out-of-state work, and that was certainly the intent of the legislature. But again, because everything is still somewhat ambiguous and is still developing, there may be some possibility that part of it might be taxed. You need to look at the specifics of the scenario, but most likely it would not be taxed. The next question was which body determines or change thereafter the 0.57% rate. So the 0.57% rate is set in statute, so only the legislature can change that rate. The Department of Revenue can make rules relating to what activity constitutes the tax base that is taxed, what activity is part of the exemptions or subtractions that is not taxed around the margins, but it's only the legislature that can change the actual tax rate itself, or I suppose the people if there's an initiative. The next question was, in the financial services industry, would the total amount of the investment made count as revenue? Examples: client rolls over an IRA of 1.5 million, or they invest 1.5 million into a mutual fund. Would each of those scenarios cause the CAT liability? That's an excellent question, and I do not know the answer off the top of my head. That would go back to looking through the 47 specific exemptions from what constitute taxable activity. My guess would be that it would not be taxed, but I would have to look through the specifics of the exemptions. I know there's exemptions for stock purchase, for example. So some of it certainly would have. I'm not confident that the entire amount is, unless I actually look through all 47 of those exemptions to find specific things that I can point to and say this specific exemption shields this activity. I would guess it probably is shielded, but I'm not 100% certain. And I mean, it would be easy to look through the statute. I just haven't looked for that specific question. Another question received was, of the hoped for $1 billion for this year, what is the projected actual collections for this year? So obviously, the economic changes through coronavirus have significantly changed projected collections. The most recent data I have on that is from the revenue forecast from last month. And in the revenue forecast, the economists projected that there will be a reduction in corporate activity tax revenue for the 2019-21 biennium of $414 million. So you have to keep in mind the 19-21 biennium where this tax started in January of 19, goes through all of 19, all of 21. The 19-21 biennium only covers through the middle of 2021. So that's 1.5 years. They project there will be a reduction in $414 million. I don't know for sure how much of that $414 million is in this calendar year versus the first part of next calendar year, but that gives you a general idea. They were expecting around $1.4 billion per calendar year initially, and $414 million reduction in 1.5 calendar years. Next question is, and this is the only other question I have right now, so if you have any more questions, please go ahead and type those in for me or for Justin. So, quote, would an out-of-state corporation doing work in Oregon have to pay CAT if that work exceeds the threshold? Yes, yes. So if you have a business, for example, that's registered in Washington and they are doing business in Oregon, most likely they would have to pay the amount. There are some legal considerations for whether a business is doing enough activity in a state to be subject to that state's taxation. But any business that's generating over $1 million in revenue most likely would satisfy those legal requirements under the Constitution. There may be a few exemptions, but for the most part, if it's an out-of-state business doing that amount of work in the state of Oregon, most likely they would exceed the threshold and have to pay the tax. But there are always exceptions, and if you have a customer or if your business is in that scenario, it would be a good thing to run by an attorney just to check, because there are some constitutional requirements and other legal requirements on when an out-of-state company can be taxed, how much activity they have to do within the state. So those are the only questions that we've received so far. So if there are no other questions, I'll turn it back over to Eric.
Thank you, Steve. Thanks to both of you, Steve and Justin, for sharing your expertise with us today and kind of reminding us that a lot of our businesses are dealing with a lot of different types of issues, but at the same time, we're kind of some of the more traditional challenges that we face, keeping up to date with employment law and keeping up to date with tax law doesn't go away. So we appreciate the heads up and the explanations. For folks that are tuning in here, also to know that the presentations are already available on our SEDCOR website on the events page. So some of the examples that the folks shared with us today. In addition to thanking Steve Elzinga and Justin Thorp for being with us today, I'd like to also thank Mark Hoyt and the rest of the team at Sherman Sherman, Johnnie, and Hoyt for their sponsorship and continued support today. We certainly appreciate the engagement and the interest and the support of SEDCOR. As you can see, we're working on another webinar. We'd normally take the summers off, but given the things are changing, we feel that there's an opportunity to at least keep sharing information with the business community and our membership. So on July 8th at noon, we're going to be providing kind of a team update on some of the work that we've been doing, highlighting some of the businesses that have we've been engaging with as they've adapted to new products and new markets around coronavirus and new retooling to serve some really important needs in the community. But also for ag industry folks that might be listening in, tomorrow morning we are doing a special event online. This is dealing with the $30 million Food Security and Farm Worker Safety Project Fund that was recently announced. And we're doing a workshop on COVID resources for farmers and farm workers with a variety of speakers and panelists to talk about resources that are available for farm businesses in the ag community. That is at 8:30 tomorrow morning. Information is on our website as well. So with that, I'd like to thank everybody for clicking in and joining us today. Thanks again to Sherman Sherman, Johnnie and Hoyt, and to Justin Thorp and Steve Elzinga for their sharing their expertise today. Have a good rest of the day. Take care.